Hi, James. Let's talk about how Australian investors have adapted to the changing rate environment. Do you think they're lagging, or do you think they're reconciling themselves with what's eventuating?
Yeah, look, I think we saw a bit of lagging. I think people were a bit unsure about whether with the interest rate changes starting last year, we saw a bit of a delay in a mix in client portfolios. But I think particularly since the start of 2023, we've seen a fairly dramatic reallocation from equities to fixed income. If we look at the fund flows between the various asset classes, we're really starting to see a risk-off approach by moving away from equities into cash and fixed income.
And is the fixed income predominantly index-linked fixed income, or are investors prepared to look more broadly into non-traditional fixed income?
It's really going across a wide range of investment strategies when it comes to the fixed income. So obviously, I think a lot of financial advisors now have a lot of tools in their chest to be able to really build a portfolio for clients in the fixed income space that really hits both that need for income, but at the same time, maybe taking a little bit more risk in the asset class that they weren't necessarily able to before.
And just another question on that is a lot of investors bunker down into private credit. Has that been partially realised to accommodate other fixed income, or is fixed income coming entirely out of cash?
I think fixed income is coming entirely out of cash and out of their equity allocation. So if anything, we're actually seeing a greater allocation to private credit over the last 6 to 12 months. And I think that goes in hand with that willingness to be able to take a little bit more risk because their income is being satisfied with their core portfolio. In the alternative space, they're actually allocating to private debt to get a little bit more of an alpha generation.
Now, we've just had our first day of the Income and Defensive Forum in Sydney. What were the takeaways from what you've heard during the course of the day?
My key takeaway was actually around the fact that there are a lot more strategies that advisors and their clients have now available to them. I think talking about, in the 2010s, trying to generate income was a pretty one-sided conversation. You were picking up, allocating to equities to pick up the dividend yield, or you were allocating to hybrids, and really sort of moving up the risk chain. I think now, taking a very, a broad approach to income generation and to defensive assets gives them a lot more tools in their chest.
There's been a lot of discussion about the impending retiree increase that's going to come through. Do you see private portfolios having to more substantially change? Because at the end, it's not like a super fund where they still have a long tail of people coming in. The retiree is the retiree at the end of a private investor fund. So how do you, any advice or any thoughts about retiree for private investors?
It's a good question. I think what we're seeing, and mainly from advisors, is the challenge of, as you say, the retiree is the retiree, and there's there's an end to that. And what they're also thinking about, and it's probably a little while talking about the intergenerational wealth transfer that will generate, and whether or not as the advisor they can actually hold on to the assets that are being inherited by their children and so forth. I think with retirees, and this sort of came up in our last session, is a lot of the anxiety around income has sort of dissipated. There was a lot of stress and a lot of concern around where income was being generated in the last sort of 10 to 15 years. That has gone away, but now they've sort of got that they're thinking about, okay, well, how do we actually build portfolio wealth into our portfolios for the next generation?
And one more about looking forward, allocations to things like alternatives or so on. Do you still see that as being underrepresented in portfolios? Do you anticipate more being added to them, or do you think people perceive their risk profile to be difficult in the current environment?
Yeah, I think that because we're still, in terms of real interest rates, it's still necessary to be able to generate a plus 5 to 6% return over and above where interest rates are. And so we're still going to see investors taking a little bit more risk in their alternative investment exposure to be able to generate that in nominal terms 11 to 12% return. And the only way you can realistically do that in this current day and age is by moving into high yield space, whether that be in private debt or private credit. To be able to generate that excess return that they really need to go over and above the cost of living.
Well, one final question for you. This event has been held in Sydney and will be held in Melbourne, and I'm sure the audience in the two cities are somewhat different. Do you have a preference between Melbourne and Sydney?
Well, having lived in both cities and more recently, obviously, in Melbourne, I'm going to have to give the edge to Melbourne purely because as an unabashed Carlton supporter, finally seeing my footy team back into the finals for the first time in 10 years is incomparable. And my kids who have never seen them play finals, it's the first time. So I'm going to give the edge to Melbourne purely because the AFL is just so much better down there.
Couldn't give it to the weather, so you'll have to go for the football.
Correct.
Thank you, James.
Thanks, Giselle.